Ladies and gentlemen of the crypto space, we're live at 11:28 a.m. on a Thursday, March 4th. And boy, oh boy, are things going on. Overnight, equities markets racing down. Obviously, I have the QQQ chart up. I got SPX, SPY, ES. I'm looking at the indexes to see how the inflated equities markets are going to hold up in a time when it makes no logical sense for them to hold up. Albeit Raul points out exactly what I talk about. And maybe I got it from him. Maybe he came about the idea himself, but everything is relative. And looking at equities markets compared to like M1 and other relative points of reference, are they really inflated? So that poses a most ridiculous way to look at least markets that are just beyond a rational state of inflation in U.S. dollar valuation. So, but what's the point of the U.S. dollar when it's being inflated beyond imagination at the M1, M2 level? So. Everything is relative. Equities markets are teetering. Overnight 10-year treasuries have been beyond a wild ride, and folks are leaning towards the definition or describing the behavior as a systemic failure. The last time I saw something to such a degree, and probably most people, was like September 2019 with the repo market meltdown, 10% on interbank interest rates. That's basically what caused our current fight, or at least is a, a marker of the start of the current financial crisis, which had nothing to do with the coronavirus. Um, March wasn't the start of anything. It started in September 2019. And today, last night, might have been another event with what happened with the 10-year bonds. And that is meaningful. And because of that, we have our eyes on the index funds. We have our eyes on what's going on with the macro crypto assets. And as I always talk about on Twitter and the stream, we need to protect the damn downside. So the vast majority of everything I do is downside protected. I mean, it's over half the portfolio, yield bearing, risk considerate, risk adjusted returns, and we're going to dive into at least one strategic play that I haven't really discussed because it's really the ultimate risk off, and it's a quick, easy way to um, funnel capital to a yield bearing position in a simple transaction. And you can only do stuff like this in the crypto space to easily get in and out of a risk minimized position to a completely risk off position. So we predominantly talked about risk minimized as we talking about LP positions of late. And on a day like today, this is where risk off is to be considered. Equity markets teeter, crypto markets scream opportunity. Let's do it. Today's episode is sponsored by Change Angel, the non-custodial swap exchange for social goods. Stop depositing on exchanges, not your crees, not your crypto, non-custodial DeFi, or nothing at all. Bam! Let's pop it over to the main screen and see who's in the stream. Zach's in the house. Always a pleasure. JD, it's all good. It's always available. JRAM, LFG, my man. Carlos, pleasure. Powder Monkey, we can do better. 21 people in the stream, 6 likes. We can do better. Trevor, thoughts on stablecoins, dollar risk, and inflation? Yeah, inflation is relative, which is a topic I've been discussing a lot lately, and value transfers from inflated assets to uninflated assets in a process called mean regression. During mean regression, uninflated assets go up. It is all relative. Just read the last part of your sentence. What's less susceptible, less likely to go down? Not about what's less likely to go down per se. It's there's always something that's positioned to go up. So I want to allocate value to the uninflated assets, and when things start to mean regress, uninflated assets go up, and that's part of the great value reallocation, the great value rotation thesis that a lot of people are talking about, and I obviously have been talking about. And we're talking about commodities mining, battery metals mining, especially. Some of those assets up like 1,000%. I saw one of my assets up 1,400% yesterday. No, a 14 bagger. Incredible. So, mean regression, include metals and the crypto space. I think there is much room for them to inflate. If you look at Bitcoin versus M1 supply, yeah, I showed that chart the other day on Twitter. Maybe we'll pull it up in a second. Let me keep going through the stream. Wave, good morning. Barry, a pleasure. Digi. Carlos, is this Noah's master class? This is my only class. I like it though. We might be in a teacher one day. We'll see how things play out. Matt's in the house. Yes, sir. Igor, Max, Rook. We're not going to pull up a chart in particular, but obviously I've talked significantly about the merits of the platform, basically the necessity of it. Even with EIP 1559 and F 2.0, it's just important to proactively protect transactions rather than defensively or just biting the bullet. So what they're doing is profound technology. Leave it at that for now. Gonzo, yo, Mr. Weeby in the house. Bavin, good morning, sir. Can we talk about what you think about staking DeFi tokens in Yeti and ASI? I don't know either one of those. Squanchy, what's up, crypto fam? Bit is in the house. Act 30 minutes till Fed time. Now we're talking, and it's actually about it's 31 minutes according to my clock, but probably down to the minute at this point. We're on the main screen. Let's look at Nasdaq. This thing looks like positioned to collapse at least 20 points. I mean, if the 100 SMA and the daily doesn't hold, it's going to run right to the 200 EMA and 200 SMA, which is actually an interesting convergence, or at least provide meaningful support. But that thing will go quick. That thing will evaporate like pulling the drain on a bathtub. Dr. T in the house from Idaho. Yes, sir. JD, morning, everyone. Another day to learn. Yeah, I'm learning too. And don't ever forget that we always are, and I always am as well. Max in the house, yeah. All right, let's keep it going. So, in conditions like this, when you're looking at macro assets teetering, especially bonds doing what they did last night, and you look at the headlines real quick, and you could smell the fear in the air. Let's give it a refresh so we see what these indexes display. Give a nice overview of the market. So they're flat. And basically, when I see stuff like this, considering what happened with the 10-year last night and the way the chart looks for QQQ, uh, folks are not doing anything. They're like frozen. This is a situation where they're like, what do I do? Do I got to sell? Am I going to buy? Is it going to rally or is it going to implode? And that's basically where the market is. It's paralyzed right now. This is a paralyzed situation. And in many regards, we see that in the crypto, macro crypto assets as well. We're hovering right around this red line, going above and below it for the last. There you go. It's the fourth, and it's been a week. So, hit it, breached it, fell, back test, breach to the upside. Looks like support held, but we're still below the 100 SMA in the 4 hour. If you go over to Ethereum, same thing with the 200 EMA in the 4 hour instead of the 100. So failed breakout, back test, breach, dip, and it looks like it's right above. There's about 3 hours left on the 4 hour candle. So, but you got the 100 SMA and the 200 SMA above. So this is some serious pressure to the downsides, but it's not going down. So this is prime territory for horizontal price action, which puts it in a very similar sentiment bucket as the equity space, which is paralyzed. It's going to chop. It's going to go up and down. We don't know whether it's bullish. We don't know whether it's bearish. And in a situation like this, you best be risk TF off. Risk off. Or risk minimized, depending on your risk tolerance level. I'll show you guys. My favorite of many protocols is 1inch. These boys paying 57%. Obviously, 1inch token is probably getting suppressed at this point. This looks about the same as it's been for a while. So liquidity is not necessarily entering the pools as a risk-off position right now. Like it's something that I've been observing lately. About 25 million has gone into the 1inch Ethereum staking pool. This is about the same APY. It's been ranging around 100, 110 for a bit now. But this is cool because it's a dollar paired pool, which offers the downside dollar value protection and upside minimization as well. So this is this type of pairing when you pair a volatile asset with a dollar stablecoin, is going to be your risk minimized position. I personally feel for myself, there's no reason for me to hold risk on, no full risk on, as in holding an asset, a raw asset. I want to pair it with something and strategically. You can have full risk on with Bancor, and that's the whole point and why it fits into a constructed portfolio. But you could pair your risk on assets with a stablecoin to experience reduced volatility as well as capitalizing significantly on principal by yield interest as well as incentivized interest. And clearly, this is some serious incentivized interest. You go over to the pools, these bad boys are yielding double digit gains. 19% for 1 inch Ethereum on just the yield. So your principal is going to appreciate that much on a yearly basis. And FUSDC is 12.267%. Take that, HSBC. You got nothing. Anyway, let me look at the stream real quick and I'll keep going with these thoughts. What I miss? What I miss? Wave. What are you? What do you normally do? Brave Bat rewards? I don't know. I don't really look at them. I probably have a couple of bucks. 154 bat. I don't know. I'm just gonna let that sit there. Maybe one day it'll be worth $10,000. Um, yeah, I guess. I mean, I don't really go to websites that are verified. Brave. Oh well, look at that. 1 inch is Brave verified. Fine. I'll give them a tip. That's pretty cool. I didn't expect that. Heirlooms in the house. Always a pleasure. Yeah, so that gives me thought because I'm Brave verified as well for my YouTube and Twitter account, yet nobody hooks it up. Just saying. What's this button? Huh. Okay, so Bancor's on fire lately. $7.11. That thing is ripping, and the total liquidity funds are flowing in. They're on the verge of deploying the final components of their Vortex protocol. And to BNT stake, this is very meaningful supply disruption, which is very interesting considering the inflation rate coupled with the vortex component, which is a burn component, and you can see it very obviously in their max supply and circulating supply. Um, and this is expected. This is quite interesting, especially this is very different tokenomics as compared to the other major AMM protocols. So this is an elastic protocol, meaning you need inflation because that's how you're able to provide incentives to participate in the system, and you need deflation to prevent excessive debasement. Extraordinary monetary policy, and they're years ahead of the other AMMs in that regard, and experience-wise in crafting monetary policy. And they have very sophisticated smart contracts, which is why interacting with them is relatively expensive. This is all meaningful, and there's no such thing as the only protocol you want to use, but the protocol properties here are meaningful, and you want to craft the portfolio, structure it with regard to balance, so that it best expresses how you feel about risk in the markets, and that's the whole point. So here you go. Here's a very I would say this is other than here, check it out. Let me show you. Other than the dollar stablecoins, that's like basically full risk off and just ridiculous yield. You could compare the stablecoins on Bancor versus Curve because there's ridiculous yield there. The difference is the incentivized yield here is denominated in BNT, and the incentivized yield on Curve is denominated in CRV. So even though Bancor might have better rates, you probably should have a CRV position as well because VECRV is like going to provide access to owning an incredible revenue stream in the next decade. So just because something has better rates doesn't necessarily mean you shouldn't diversify at all. Diversification is a necessity, especially I wouldn't, I'd say these protocols are predominantly de-risked from a security standpoint, but there's always chances, which is a minor part of the reason I would argue to diversify amongst these protocols. Personally, the obvious reason to diversify amongst these protocols is because they're all going to be the majors. These are going to be serious captains of industry, and I want to be part of the tokenomics, part of the monetary policy that these protocols and these teams have crafted. Powerful, powerful protocols. Wave Mapper, I'll hook you up. Yes, thank you. Twitter and YouTube, I do have the subscription. You don't. I don't do this for tips. I don't do this for compensation. I do this because hopefully it'll help, and it's a good way also for me to have better clarity of my ideas and my narrative over time. It matures. Do you think Bancor will rival Sushi Swap or Uniswap in terms of TVL and swap volume? I believe they're already close to it at this point. $1.2 billion. Does it show here? 1.18 and Sushi. It's a little less than half. It's what, a third? Cool. So that's pretty much rivaling it, I would argue. Uniswap is a different level. Uniswap is on another level. They're massive. That's 4 billion. That's incredible. That's huge. Yeah, but it's already rivaling it. It's over $1 billion of TVL. So that's rivaling it. What else? Let's take a look at Curve real quick. So Curve yields are just on another level also. But the kicker with Curve is the monetary policy. So you have to lock CRV into VECRV in order to get the right side of this boost meter. And clearly there's some significant yields being thrown around on the boost meter. 226%. Can you imagine throwing 100 grand in there and getting $226,000 a year? Just for depositing stable coins in a protocol that's earning 14% double digit interest incentivized by 226%. Wow. But you're going to have a heck of a curve position. I'll show you guys how to do that real quick. No, I don't want to log in right now. I want to go to the calculator. So let's say you want those big gains, and here's USDP. Let's say you want to put 100,000. Let's say you have 25,000 curve. Is it going to calculate without being logged in? Possibly not. You say, look, no, 4 years. It's not calculating because I'm not logged in. Why is pool liquidity 0? It's throwing it off. But the whole point is you have to have curve and lock it for VE curve in order to experience the right side of the boostometer. And that's their monetary policy, and that's basically a deflationary pressure. It's removing circulating supply. Their inflation causes deflation. I mean, literally, the central banks around the world have nothing on these monetary policies. Literally, incentivized inflation is used to create deflation. That's just incredible. So, in situations like what's going on in macro financials, you really want to think about these risk minimized yield bearing positions. And Curve offers significant opportunity. Bancor offers significant opportunity, not just in its dollar pools, but obviously Bancor itself, BNT, as well as the other side of the pool. Rook is offering 15% incentivized yield at 3.79% interest. Avi's giving good yields. I mean, these are all double digit yields. It's all double digit yields. It's crazy. And Bancor is just ripping 716. It just keeps going up. And you could get 80%, 90% on your BNT pretty easily. Spreads amongst these pools. Let's take a look at the stream real quick. Do you think, hey Noah, posting this on subreddit right now? It sounds good, Archie. The goal of these streams is protection, risk mitigation. Too many people just buy an asset, watch it go up, and watch it go straight down. And the it is a necessity to know why you're doing that and to question why is that okay to see $1,000 to turn into $10,000 to turn into $800. Why? Why do people do that? And I don't have an answer. Folks need to have an answer for themselves. But there's better ways, and now since 2020, since May of 2020, there's new positions to be had that you can just sit in and earn it significant interest, double, triple digit interest often. And you're not exposed to straight up, straight down. You make a fortune, you lose a fortune. Um, and that's meaningful because why would you do that? And we should know better. And it's all about just education, and that's what I hope to make a difference with. If you're going to be risk on and you really just want to own Ethereum and you're like, oh my God, it's going to change everything, and if Ethereum goes to $10,000 and it goes back to $4,000, one, that's going to be brutal. Two, you might as well not be holding the Ethereum. You might as well have it in a Bancor pool, because when it goes to 10,000, it goes to 4,000. You're getting 6% interest with 30% incentivized yield. So I don't see any real reason whatsoever to hold a naked position anymore with these DeFi protocols that have emerged and solidified over the last 1 year. Almost everything, unless it's like Polkadot or Cosmos or old school UTXO blockchains, Block, Syscoin, um, StakeNet, 4, and Firo, which was Zcoin. I mean, those are old school UTXO chains, but this is obviously the DeFi space. And interestingly enough, it's just the beginning. This is the Ethereum DeFi space only. And we're going to get into the other platforms as composability, cross chain composability, and interoperability comes online really quickly, because Andre is an absolute magician, to say the least. Uh, Curve is paid out in real time. Real time. Every second you're getting more curve. And it's the same thing with all the protocols. You're literally getting real time interest. Banks with their, or dividend stocks with REITs, and you're getting it monthly with Realty Income Corporation, or quarterly with other assets. Ridiculous. Does it make sense to do this with 10K? Probably not. But Bancor, it does, because 10K, if you are in a chosen asset that you have conviction in, you have full upside exposure. So Rook has much upside potential. It could go down, it could go up. You're in a position with a moderate portfolio. It depends on your risk tolerance, where you want to grow your capital, you want to grow your principal. So only you can answer how much risk you want to take. I know myself, I've personally taken excessive risk to get to the position where I am, that I could just put value inside of very stable positions and earn a decent income. But in order to get here, I had to take very calculated and well thought out risk. And this isn't this right now. The market isn't where you take a risk. This is where you risk off, whether you're trading and you're going long, or you're in a risk on. You want a risk on position. This is where you risk off, because you don't know whether it's going to go up or down. When you go risk on, you need to know your technicals. When you see breakouts significantly departing from a long-term moving average, or you see a resistance flip into support, or an inverse head and shoulders and then a breakout, like if this right here breaches the 200 SMA and the 100 SMA to the upside, following this inverse head and shoulders right here, combined with Jay Powell providing some meaningful market stabilizing guidance, yeah, now you're talking. And so what I always tell folks with regard to entries is stuff like this. You got to wait for it to go up. So what you want is the breach to the upside, the retest, and the higher high. Charlie knows all about it. I've been talking about this for a long time at this point. Breach to the upside. So you don't buy it now. You wait for it to go up. I mean, clearly, if it's a significant breakdown, and my eye is here on the daily with a 100 SMA mean regression. So as JT talks about, I don't know, where are we? We're right about here. We're looking for probably a C leg down. And if you notice, A, B, C. So that's an ABC corrective pattern, and Elliott wave theory type stuff. And that would make sense. So right now we have no idea what's going on. Jay Powell could easily light a fire under the market, yield curve control, Operation Twister 1 2 3, or whatever the hell it's going to be, and then it just goes straight back up. And JT would probably even agree. If we breach, he does different boxes and looks at the technicals different than me. But the interesting thing is, We look at the technicals differently, but it's the same exact analysis, just with different moving averages, and just he's got years of experience, and I, it doesn't matter. It's the same outcome, and I'm sure a breach to the upside here, a retest, and a higher high, and you got some bullishness, and pretty much an invalidation of the larger ABC corrective pattern. Just interesting stuff. Um, Powder Monkey says he doesn't have 100K. Most people don't have 100K. I understand. And in order to grow your capital, you have to take risk. And only you can answer how much risk you want to take. Um, it's not something that could be told to you. It's a personal choice. And I myself am extremely risk adverse. So I was lucky to get to where I am because I didn't like taking risks and I was very prudent. You know, people take 100x leverage and make millions and massive risk, and I could never do that. Not with a mortgage, kids, and wife, and all that stuff. Aaron, what's a better place to park your stables, in Urn Vault or Rook and Why? Okay, Rook is pretty cool. The emissions are in a volatile asset, but the volatile asset could have significant upside. Rook's a great place to park value. Keep it down. But stables are incredible. Um, Ave's throwing around single digit yields. And it's so easy to get into an Ave position. I'll go over to 1inch. And if you have, let's say, whatever, you got Ethereum and you want to get into an Ave position, just type in AUSDC and transfer your Ethereum to AUSDC, and you are now in an Ave position. And you're automatically getting interest on your USDC. Not many folks knew about that bad boy, but you could just go right directly into an interest-bearing dollar stablecoin, giving you yield that makes HSBC look pretty pathetic. Curve 3 pool, but I don't have any curve to get the multiplier. Sure, so that's the complexity curve. You want curve to get the multiplier, or Rook, which pays a high API without needing to buy any. Well, these are choices that you have to make, but you know, I like curve. I like Keeper DAO. I like Bancor. I love 1inch. I think Urine is fascinating. Alpha Homora has a lot of potential depending on risk tolerance. Alchemix, I threw some money in Alchemix, like bunch of dye and Alchemix, which is pretty cool. This has been getting some attention because you let's say you put in 10 grand and borrow 5,000 ALDAI, it pays itself off in 4 years. Your debt, your $5,000 of borrowed debt, will automatically pay itself off. Well, it's not 5; it's 3 years, 3 and change years. But it'll tell you when the maturity is, and then you take your ALUSD and you can stake it to get ALCX rewards. So, you know, my wife used to take dollars out of one of our checking accounts and set it aside for the girls, and I always get into an argument with her because I tell her she's losing 15% per year. You're losing money, honey. Wife, you're losing money. So what did I do? I took the exact same amount that she's been saving for like years, and I threw it into here. And I'm like, honey, I set up a bank account for the girls. That's pretty cool. And it's the same amount that she's been taking out for years. And I'm getting, instead of losing 15% a year, I'm getting 13.66%. So it's still going to be losing about 1.34%, considering fiat debasement. But the whole point is you're also getting your incentivized yield in the DAO protocol tokens. And in 5 years' time, these DAO protocols, this is not trivial. The team, and particularly, was it, what's her name? Scruple? She's cool. She's really cool. Scruple? Scooby? Oh my God, I'm so bad. I forget, but when one of these protocols emerges and they start to interact with like Banteg and Andre and the Aave team, and they all really just learn off each other. Um, Scooby, yeah, Scoopy Trooples. That's awesome. That's so cool, and they're extraordinarily brilliant. You know, I don't have a capacity to do what they do, and they've built some incredible protocols, and it's monetary policy with debt and leverage and inflation and deflation, and it's really extraordinary. Um, Andre is a magician. Yes, he can make it disappear really fast, but on the other hand, these V1 and V2 urine pools have hundreds of millions of dollars in them, and they're profoundly meaningful, guys. So yeah, there's a bug every once in a while. They have been getting usually. If you looked at these contracts, I've looked at the source code. They're brilliant. I know source code. I would have to uh, learn to be able to execute on my own. But the architecture, the structure, the patterns, the commentary is extraordinary intelligence being deployed in building of these contracts. They're brilliant. And there's hundreds of millions of dollars in here earning significant yield. 57% on Curve SF, incredible. 21% on just DAI, 26% on USDC. This is crazy stuff. Um, Powder Monkey, thank you. You're very welcome. Ask any questions, anyone ever. I'm more than happy to always help. J Powell's coming up in 7 minutes. Charlie G, can anybody take advantage of all this with under 5K? I don't have a recommendation. You're going to be doing 100, 200, $300 Ethereum transactions. This is why such a huge amount of persons started to try and do things on Binance Smart Chain. But there was a $34 million rug pull yesterday on Binance Smart Chain. So, that thing's a dumpster fire at this point. You're not, I mean, 5 grand if you get 100% interest in 10 years, you'll have some nice gains, especially compounded. But to attain a larger degree of principal, Charlie, you probably want to assess your risk tolerance level and get a 10x and then get a 10x and get a 10x and get a 10x it is not easy to get to critical mass of value where principal can be deployed for double digit yield and have it generate a meaningful salary. Just being honest, I'm always here and I'm more than happy to help as best I can. SJ, podcast on Spotify? No idea. I barely have enough time to do YouTube. When Cardano comes available, are you going to test it? No. I think Cardano is a big deal. I don't care about the platform. What I care about is DeFi that emerges. I am a DeFi maximalist at this point, and all I care about is being able to deploy liquidity and take positions that are lucrative, whether it's on Cardano, whether it's on Polkadot, Cosmos, Phantom, Matic, or Ethereum. Great. Give me a D app, let it interact on whatever protocol it wants to, and throw a percent interest next to it. Prove that the protocol is stable, dependable, reliable, and trustworthy, and then it doesn't matter what chain it's on. So I don't really have much interest in the asset itself. I believe in network effect, which is basically a physics principle in many regards. Just I was talking about relativity and Einstein. So network effect really boils down to natural phenomena and the way the universe operates. Um, the ongoing disruptions almost are never disrupted all throughout history. It takes a long time. Lyft will never disrupt Uber. Apple never disrupted Microsoft business. Now, Microsoft owns enterprise. No matter how big Apple gets, Apple will not disrupt Microsoft's business enterprise solutions. And Ethereum's not going to be disrupted. The appropriate way to look at it from an analogy perspective is Ethereum is Fifth Avenue, and you're going to have your Times Square, you're going to have your Village, and you're going to have your Canal Street, and then you're going to have your flea market. Or if you're talking cars, you're going to have your Ferrari, you're going to have your Mercedes, you're going to have your Toyota, and then you're going to have your public bus city transportation. Obviously, Binance Smart Chain is like a public city transportation operated by the city, a centralized authority. Ethereum is the Ferrari because it's expensive as hell to execute on the network. And you're probably talking about like Cosmos and Polkadot are nice, decent Corollas. So where everyone else fits into the mix, you got to reach critical mass. You need TVL, and you need monetary velocity, borrowing, and lending. So as Hodgkinson's so well said, sure, DeFi is easy, but network effect is not. And just because there's a lot of stakers on Cardano, that doesn't mean anything. What you want is $10 billion in lending protocols earning interest. It takes a while to build monetary velocity. It's a chicken and the egg. That's the way network effect works. Chicken and the egg. Ryan, when shopping for a stablecoin LP position, is it better to look for straight APR rewards? I was thinking about Bancor. That's your choice. Better is subjective. Bancor offers significant yield. And if you're talking about stable, what are you talking about? Like Aave? I mean, these are great yields, but they're single digit yields. This isn't sustainable. At spot rate, it'll get back down to 10% real quick. So don't FOMO into these types of positions. And frankly, I wouldn't even use this portal. I would just go over here and you get AUSDC. Ethereum straight to dollar stablecoin earning interest in real time goes directly into your wallet. Fascinating, huh? Script my man, hooking it up with $5. I really appreciate it. Thank you. Bancor and Cosmos. Yeah, man, Cosmos is huge. Made a fortune this year on Cosmos. And that so here, check this out. This is what's going on if you haven't noticed, and it just makes perfect sense. Bitcoin, Ethereum smart contracts, Binance smart contracts, Cardano smart contracts, Polkadot smart contracts. When Cosmos, when Layer 2s, Matic, Loopring, when Phantom, and the newer, less talked about other alternate L1 chains or L2s, Ethereum L2s. You could consider them all L2s to Ethereum in many regards because it has the network effect. It's 5 times the size. That's massive. And what else is going to run up in the markets? Uniswap. That's going to keep on going. Aave. 1 inch is down here. Synthetics. It's the DeFi protocols because of the monetary velocity. Kusama, Sushi, Compound, Avalanche. Avalanche is another, will end up being composable part of the whole DeFi package. Pancake Swap. Pancake Swap. X Sushi, yield bearing sushi. Crazy. Phantom. I mean, look at this top 100. Yearn. 0x has been killing it. Ren's been killing it. Algorand, another composable implementation, inevitably. RenBTC, DigiBytes, good to see, but we need some composability. We need some interoperability, and or Anthem ID could just run DigiByte to $5 itself at some point. But very speculative, full risk on, full upside, full downside. And as I tell you guys, I'm not interested in full upside, full downside. I'm interested in risk mitigated positions that give me interest because I want to turn my principal into a salary. Bancor is getting up there with 84. Loop rings on the list. 1 inch. I think 1 inch, I've written some nice posts about 1 inch, talking about some technical details, serious tokenomics and monetary policy, and Curve coming in at 100. Look at this top 100. This top 100 was not the same last year. Incredible difference. First Noah talks on subreddit. Archie's hooking it up. I hope I help people. There's a lot of choices to make and new ways to manage your value, protect your value, and turn your value, your principal, into a salary so your money works for you instead of you working for money. Bit of so much new info. Where do I get more details? I don't even know what questions to ask. So that's the first thing. Assess where you are and think of questions to take where you are one step further. What is DeFi? What is the acronym? What is an AMM, an automated market maker? What is a liquidity pool? Offering people the ability to trade. And a liquidity pool is you're the bank instead of the bank being the bank. You get the interest instead of the bank getting the interest. So figure out the questions, and I will be here. It's my pleasure. Next one will be marketed much more. Thank you, Archie. Hope I help. Zach, Scoopy. Yeah, Scoopy Triples. Scooby Snacks. Zach. Whoa, I missed a lot of stream comments. I'm going to try and get through a couple of them because I'm pretty sure Powell's talking right now. Jay hooking it up with $5. I really appreciate it. Do you think of time horizon when you invest? Yes. I don't mind about bear markets when I'm talking about Polkadot and Cosmos. I'm going to hold that for another couple of years. Ethereum, I'm in and out because I wanted more of it, and I really don't want to get hammered too much inside of this type of position. This is where I want to park a lot of capital. But if we're going to take a 20, 30% dip, sure, this is downside protective in a normal volatile market, 5%, 10% swings. But if you get a 30% dip, which is exactly what I drew here on the daily, an ABC corrected pattern, I'd rather capitalize on it than protect. So there's a difference between being protective of your value versus capitalizing on a significant downside move. Squanchy, I got 98% of my portfolio earning yield. Thank you, Noah. So yield, protect. Even risk off, you're getting yield. So what you do is if you don't know where you are with the portfolio, risk off. Get it into DAI, USDC, GUSD, USDT, and then slowly crank up the risk on. You get it. I mean, literally, you're taking dollars from the real world and you can put them into dollars, getting 6%, and then figure out how to get 10%, then figure out how to get 15%, taking incrementally more risk. So you dial up the risk, you increase the reward, and now you know the process to go from risk on to risk off. Start with the baseline, which is full risk off. And as you get more comfortable going risk on and the process of transferring to risk off, that's how you grow your capital. Gonzo, you're very welcome. Trevor, real estate rentals, inevitable. I think that's an interesting play, albeit real estate is a complex market with a long history. Follow George Gammon. He loves his real estate. Um, let's keep it going. I'm going to finish this up real quick. I might have to skip a couple of them. Script, I like the comparisons, Noah, with the chains and cars, right? So to understand this stuff, we need metaphors and analogies. I hope it helps. Pangolin can be a nice exposure to DeFi with 5K, 2K fees are great. Yeah, I'm just not familiar with it. Can't go all in, can't spread too thin, and there's no way you can own everything you want to own. I read today on Twitter that buying BNT here is like buying SNX as 50 cents. Well, that's a heck of a hyperbole. But man, I love the idea of thinking of SNX at 50 cents. Those were good days. I think my first SNX was like 70 cents, 65 cents. So that was nice. That was about March last year, a little over a year ago. Chet's in the house. Always a pleasure, my brother. Stelios, yes. John McGuire, new folks should follow DeFi Dad and Bankless. Those are incredible resources. DeFi Dad gives great tutorials, and Bankless just gives you a very high level, technical level review of DeFi. Incredible resources. Sure, you might like my ideology and rationale for protecting value, appreciating principal, generating revenue, and turning value into a salary. But DeFi Dad is going to show you what to click in order to do it, and Bankless is going to give you a very different perspective than the way I talk about the DeFi and Ethereum space. Very meaningful data. Compounding yield is my favorite phrase. Oh yeah. Doge Pound, trial and error. Everything is a learning experience always. Happy Bear, imagine losing all your money in some sketchy crypto pool. So don't do sketchy crypto pools. Do the majors. The majors have billions of dollars TVL. The majors have some of the smartest people on the planet. Some of them are partnered with corporations at this point, and most of them have billions of dollars in treasury reserves because Uniswap has billions of dollars in treasury reserves at this point. They're basically a corporate titan. If they were on the New York Stock Exchange, they'd be a unicorn, $1 billion valuation. So everything has changed, and stay away from XYZ swap that has a developer that forks some code from a protocol that probably has no idea what they're doing. So stick with the majors. These are basically the beginnings of banking infrastructure. I mean, literally, Aave, this is basically a bank at this point. Ryan, is 10K USDC enough for his stablecoin LP position or better to get some 10Xs first? Uh, only you can answer that. I can't provide financial advice to that degree. Only you could assess how much risk you want to take to get your first 10Xs. I am JD, sir. Will I be able to get decent yield if I only have $200? No. I'm sorry. You're not. When you're dealing with entry to the market, $200, you're gonna have to put it into USDC and go to work. You get $1,000. Put it into USDC. You go to work. You get $1,000. You put it into USDC. In 5 years, you got $50,000. Then you could do something a little bit more strategic. But $200, you can't do much, my friend. JRAM, what's up, Noah? What do you think of XRT? No idea. No idea what it is. All right, 12:13, boys and girls. Let's go see what Jay Powell's talking about to save the financial system. Let's glance over real quick at QQQ if he did a miracle. No, he did nothing yet. So I wish you all a wonderful day. Thursday, March 4th, 50 people in the stream, 30 likes. We can do better. I wish you all a good one, and I will see you all tomorrow. Peace.